As an investment channel, I hope to provide you useful tools and knowledge that you will not find anywhere on YouTube or even in the business media or on Wall Street. I hope to give you an edge that helps you build a lasting stock portfolio that will sustain your future. But at times, it's also good to take a look at the past. So let's get started. A major pillar of support for equity prices is the corporate buyback. And as this graph shows, there's a correlation between buybacks and the S&P 500 going back to at least the year 2000. And of course, for the year 2018, this is an estimate since we're only about halfway through. And according to Goldman Sachs, they claim that corporations have been the biggest class of buyers of equities since 2010, easily surpassing ETFs, foreign investors, mutual funds, households, and pension funds. And of course, this has been done primarily with cheap interest rates. But what happens if interest rates substantially rise? That pillar will be removed. And this chart I call the illusion of prosperity. And the illusion of economic growth has been fueled by the ever-increasing levels of debt to support consumption. However, if you back out the level of debt, you get a better picture of what is actually happening economically. And as you can see here in this chart, the blue line, that's the real GDP. And then the orange line or red line, which does start out at the same point, but then drops off precipitously, that's the debt-free real GDP growth. And when credit creation can no longer be sustained, the markets must begin to clear the excesses before the cycle can begin again. The clearing process is going to be very substantial, with the economy currently requiring about $3.50 of debt to create $1 of economic growth. So the reversion to a structurally manageable level of debt would involve a $25 trillion reduction of total credit market debt from the current levels. Ouch. And this chart is titled, "The Average is Not the Rule." And the chart shows the S&P 500 as compared to annualized returns and the average of market returns since the year 1900. And as you can see, the blue lines heading up and then the red lines heading down, those are your annual returns, either positive or negative. And sometimes you have a year up, sometimes you have multiple years up. But as well, you have a year down and maybe multiple years down. And over the last 118 years, the market has never produced a 6% return every single year, even though the average has been about 6.87%. So assuming that the markets have a set return each year, as one would expect from, say, a bond, is grossly flawed. While there are many years that far exceed the average of 6%, there are also many years that don't. So then again, this is why the 6% is the average and not the rule. And this chart is titled The Optimistic Investor. And on the left axis there, that's the cumulative growth of the S&P 500 index. And the red boxes there you see is the cumulative percentage change in earnings. And then you have the S&P 500, that cumulative percentage increase. And so you see that since the end of 2014, investors are paying twice the rate of earnings growth. And this chart here does contain some estimates for 2018 going into 2019. But no matter how you look at the data, the point remains the same. Investors are currently overpaying today for a stream of future sales and or earnings growth, which may or may not occur in the future. And so the risk, as always, is disappointment. This chart I have titled Depressing Economic Reality, and the chart shows the 5-year averages of wages, real economic growth, and productivity. And the vertical gray lines, those are recessionary periods. The red line, as you can see, is the 5-year average of productivity. The dark blue is the 5-year average of wage growth. And then the gray or blue-gray is the 5-year average of real GDP growth. So you need to notice there the yellow shaded area on the right of the chart. And you can see that following the great financial crisis, the government and the Federal Reserve decided it was prudent to inject more than $33 trillion in debt-laden injections into the economy, believing such would stimulate an economic resurgence. Well, it hasn't. What it has done is it's provided a depressing economic reality. And this chart I've called the leverage lovers. And there's two problems currently being dismissed to support the bullish bias. And the first is that while investors have been chasing returns in the so-called can't lose market, they've also been piling on leverage in order to increase their returns. And negative free cash flow balances are now at their highest levels in market history. And so, yes, margin debt does increase as asset prices increase. However, just as the leverage provides the liquidity to push asset prices higher, the reverse is also true. And then the second problem here is the liquidity of ETFs themselves. When the robot trading algorithms begin to reverse, it will not be a slow and methodical process, but rather a stampede with little regard to price, valuation, or fundamental measures, as the exit will become very narrow and very crowded with those leverage lovers. And this last chart here is titled Simple Method of Risk Management. And it shows the difference between a buy and hold strategy versus a risk managed strategy. So follow me. The chart here shows $1,000 invested in the S&P 500 back in 1997 on a capital appreciation basis only. Don't worry about that too much. The reddish line there toward the lower portion of the chart, that is simply the buy and hold strategy. And the blue line toward the top is a switch to cash strategy. Now, you switch to cash when the 200 DMA is broken. So when it's broken on the downside, from the top moving down, when it's broken, that's when you sell and switch to cash. When you're going on the way up and it breaks through on the upside, that's when you go into stocks. So you can clearly see that the strategy of switching to cash is better, no matter what Warren Buffett says. So even with trading costs, the benefit of the strategy, you can see it's pretty apparent, but it's really hard to do. And that's why the majority of investors fail at investing over longer periods of time. Adhering to a discipline. Any discipline is hard. So even the buy and hold fails when the pain exceeds an individual's tolerance for loss. But if you can hold and you can adhere to a discipline, you're going to be much better off. So the point is, develop a strategy and follow it. If you do, you have a much better chance of succeeding. And lastly, subscribe to this channel, because if you do, you'll also increase your chance of success. So, for Chew Dog Charts, thank you.